Financial report. Introduction. A financial report is a document that contains financial information about a company for a specific period. The financial report includes the income statement, balance sheet, cash flow statement, and financial ratio analysis of the company. The purpose of the financial report is to provide accurate and reliable information to stakeholders of the company, such as owners, investors, creditors, and the government. Income statement. Income. Product A sales, Product B sales, Product C sales. Expenses. Salary and wages expense, building rent expense. Tax expense. Gross profit. Gross profit is calculated by subtracting the total expenses from the total income. Other expenses. Other expenses include costs that are not part of operational expenses, such as interest expenses. Net profit. Net profit is calculated by subtracting other expenses from gross profit. Current assets. Cash and cash equivalents. Accounts receivable. Inventory. Prepaid expenses. Other current assets. Non-current assets. Long-term investments. Fixed assets. Other non-current assets. Current liabilities. Accounts payable. Bank loans. Other current liabilities. Unearned revenue. Other current liabilities. Non-current liabilities. Long-term debt. Other non-current liabilities. Equity. Common stock. Retained earnings. Other equity. Current assets. Cash receipts. Cash receipts include all the money that comes into the company during a specific period. This can include sales of products or services, returns on investments, or other sources of income. Cash disbursements. Cash disbursements include all the money spent by the company during a specific period. This can include operating expenses, asset purchases, debt payments, or other expenditures. Net cash flow. Net cash flow is the difference between cash receipts and cash disbursements during a specific period. It provides an overview of the financial health of the company and its ability to finance both current operations and future investments. Profitability ratios. Gross profit ratio. Net profit ratio. Gross profit margin ratio. Net profit margin ratio. Liquidity ratios. Current ratio. Quick ratio. Solvency ratios. Debt to equity ratio. Long-term debt to equity ratio. Debt to total assets ratio. Conclusion. From the presented financial report, it can be observed that the company experienced an increase in net profit during the period. The company's balance sheet also reflects growth in assets and equity. However, the cash flow statement indicates significant cash outflows for investments and debt payments. Financial ratio analysis suggests that the company maintains a reasonably good level of liquidity, but there is a decrease in profitability and asset efficiency. Overall, the company still has the potential to improve its financial performance in the future by optimizing cash utilization and enhancing operational efficiency.